Hello, everyone. Stephen Furness here, Director of MGD Wealth and Chair of our Investment Committee efforts here. Today is the 3rd of April, 2025, and I'm really pleased to be joined by Jack Sutherland, who's Associate Director of Investments at WTW. WTW are one of our major asset consultant partners here, long-term partner to the Investment Committee arrangements here at MGD Wealth. Welcome, Jack.
Hi, Stephen. Great to be here.
Now, Jack has spoken to us before, and as many of you know, Jack's a key part of WTW's thinking from macro economic sort of landscape and what's going on in the world. Is that a fair summary, Jack?
Yeah, that's a key part of my role is understanding what's happening in global markets and the likely implication of our expectations on our clients' portfolios.
Yeah, very good, very good. So, so it's Liberation Day today, Jack. Apparently, that's the. So lots of announcements overnight, early morning from out of the US and tariffs regime, and also clearly domestically, we've got the political climate. We've got a federal election coming up. So I thought we'd spend a few minutes getting your views on the broader global economic sort of landscape. We had an investment committee towards the end of February where you certainly presented your broader strategic review. Then few things have changed since then. So be interested in your insights, Jack.
Yeah, so a few things have changed since then. We did have a decent amount of confidence in US growth remaining fairly strong this year. And that was in light of our expectations around, the key areas of US policy under the new administration being sort of trade, immigration, taxes and spending and regulation, with most of those being, well, particularly taxes and spending and regulation being quite favorable to economic growth and starting off with a fairly favorable economic growth landscape, coming into the year. The trade expectations were always going to be a challenge to that view, and the outcome of Liberation Day has certainly brought some of that into question, and we can sort of delve into that in a little bit more detail. But essentially, the long and short of it is that the level of tariffs that have been announced today are likely to have more of a material impact on US inflation. They're going to be more inflationary, or inflation will be higher than what we were originally forecasting, and that there's likely to be a reduction in US growth relative to our forecast as well.
So in late February when we had investment committee here, there were sort of 5 major themes then that you talked about. The US business cycle being strong, divergence building up in global economies. There was a thematic around the Japanese economy, etc. Right? Inflation risk, the two-sided equation. Does that broadly stay in place, and some of the liberation tariff stuff is more shorter term noise, or is it have a really big impact on your assessments of the go forward?
So in terms of the global economy and the Japanese economy, which was the most divergent economy that we had in that assessment, I think that largely stands. There's been a little bit of an uptick in growth in Europe. That was a little bit of a surprise to us, and that was largely driven by fiscal support, larger amount of fiscal support following the German election than we were expecting. So things are actually looking a bit better in Europe. The US view is what's sort of challenged the most, obviously, by these tariffs. And then that's likely to have a flow-on effect to the economy globally. And yeah, so I think our view will temper from here a bit on the US. That being said, there are some positives. There was a lot of uncertainty regarding how the tariffs would play out. I don't think things are totally settled from here. The Trump administration has mentioned that they are open to negotiation on all of these tariff rates that they've announced today. And so there's a decent chance that tariff rates are reduced relative to what's been announced today if those negotiations sort of go ahead and are quite positive. So that's a potential tailwind. And then there's also the other components of the Trump administration's fiscal policy, particularly around tax cuts, that are likely to be a boost to the US economy. And that none of those have really taken effect yet. And so that could lead to a sort of bit of a resurgence in the US later in the year if those turn out to be as positive as we initially expected.
Yeah, yes. And when you're dealing internally, obviously you and your colleagues are framing, bigger picture macroeconomic views. When you're talking to your investment team, how do they use your information to sort of adjust the sales portfolio strategy wise, or is it still a matter of taking a longer term view on portfolio construction?
So fundamentally, the long-term view is the most important driver of your outcomes in an investment portfolio. And that's the case across our entire client base, but particularly important for wealth clients. That being said, we do have expectations about how different economies will perform, and that shorter term performance can move the dial in certain instances. So we will take a view here and there to overweight or underweight different asset classes, different sectors, different regions, in order to capitalize on those expectations where we think it's appropriate. But that's really a sort of addition on top of your total portfolio return, where we're expecting to try and add a small incremental gain on top of the kind of total portfolio return that you're expecting over a really long period. So it's important, but it's more important to be invested for the long term.
Yeah, and as per our sort of investment philosophy here at MGD about matching cash flows with appropriate investment timeframes, so you can get a better handle on managing sequencing risk and what might come in with shorter term volatility in markets. So just on the tariffs thing, just sort of closing out that, it's crystal ball sort of stuff, but what have you got a feel for what might play out in the next few months? Is it a negotiation game to then settle down to a sort of more even keel on it all?
Yeah, it seems like the most important thing for the Trump administration is balancing the trade deficit that the US has with a lot of countries. So there's two ways that can really go from here. Other countries might take this quite negatively, and it could lead to essentially a trade war where negotiations aren't particularly positive, and that is likely to be quite negative for the global economy. It could very likely push the US into a recession and drag the global economy down with it, and that would be a negative outcome for global equities over the sort of short to medium term. That being said, Trump is a master negotiator by his own right, if you will. And I think that there's a very high chance that the positioning of these tariffs has been set primarily as a negotiation tool to try and improve US trade relations in general.
Yeah.
And so I think there's a decent chance that negotiations could lead to material reductions from here, which would be essentially a boon for the for equity markets, because they've now priced in the fairly negative outcomes.
Yeah, well, time will tell. Just domestically, just closing out domestically, Jack, you've a lot of families curious, interested, concerned about the interest rate environment here. What's the house view on how that might play out over the course of the next year?
Yeah, so we discussed this at our last catch up, and yeah, we did note Australia is sort of a long way behind other economies on the interest rate cutting cycle, and that remains to be the case. The RBA left the cash rate unchanged at their meeting on Tuesday at 4.1%. Their rhetoric was that, yes, they've seen CPI sort of come now into the target bands fairly comfortably, and that labour force pressures are starting to ease. I think the labour force participation rate has fallen, employment has fallen slightly, and both of those things are sort of leading indicators of a weakening labour market, which is positive for disinflation. So all in all, we do think that the RBA will have room to cut rates at least a couple more times this year. That being said, there are inflationary pressures that are coming from the global environment, or potentially to come from the global environment with the tariffs that have been announced. Not likely to affect Australia directly that much, but affecting our trade partners like China quite materially. And the government's announced budget is quite stimulatory in nature, and the government's expectations for inflation are significantly below what the RBA's are. So the RBA are seeing risks there. They noted that in their announcement alongside the decision to keep rates on hold. So I think they're just wanting a little bit more surety that these disinflationary forces are more prominent than the potential risks that are sort of out there at the edges. But all in all, we do think it's likely that interest rates should come down a bit this year.
Yeah, well, certainly a lot of people hanging on that. All right, Jack, really appreciate your time today. We really appreciate the economic macro overview and obviously the relationship and seeing that feed through to portfolio construction for our business and ultimately our clients. So appreciate your time. Just for people viewing this, just a reminder, this is general information only. As always, you should talk to your own advisor, client advisor here at MGD, in relation to any personal advice or queries that arise out of this discussion. Thank you all, and catch up.
Thanks very much, Stephen.
Thanks, Jack.
See you next time.